Let's get started. For those of you who are in here, my name is Danny Condon. I'm Chief Revenue Officer at Blockware Solutions. We've got a few others on the panel, if you will, today. So Blake Davis is going to lead us off. He's going to talk about macro, kind of a macro landscape, and then more specifically get into what he's seeing in the equities market. Blake's an equity analyst at Blockware Solutions, and specifically, we'll really be touching on Bitcoin exposed equities. All right. Joe Burnett is the head analyst at Blockware Solutions, working on the Blockware Intelligence team. Joe's going to primarily cover, what he's seeing in the mining world right now. And then Mitchell Askew is another analyst on the Blockware Solutions team. Mitch is going to primarily cover what he's seeing from a kind of Bitcoin network specific on-chain analytics, kind of getting into that world a little bit. So, as we've done these spaces, we've gotten probably more and more organic with the discussion. So we'll just kind of toss the ball around on a few different topics. And with that, let's get rolling. So Blake, what are you seeing, man, from kind of macro and equity perspective?
Yeah, so like you said, I want to talk about equities and I want to talk about crypto equities specifically. But I want to start off just kind of talking about the Fed because I think that's the real driver of the markets now, and especially in the last few weeks, we've really seen this kind of narrative changing. So in 2022, what's been driving the markets, or I should say, what's been driving the Fed is they're trying to raise rates to a level that suppresses demand as quickly as possible, right? And that's why we're seeing these 75 basis point rate hikes, which is historically an extremely aggressive move for the Fed. Especially looking back, post Volcker era. So it was originally in this year, it was all about how fast can we raise rates and how quickly can we get them to a level that's suppressive of demand. But now that narrative's kind of shifting because we've already raised rates extremely aggressively. So now it's less about making sure that rates are raised faster, and it's more about what level are the rates going to be left at so that it can suppress that demand and bring down inflation. So at the moment, in the last Fed meeting, they released a Fed dot plot, which there's 19 members in the Fed Open Market Committee, FOMC, and it plots where those members see interest rates being at the end of the year for the next several years. So based off of the Fed officials, 17 out of the 19 officials saw interest rates above 5% at the end of 2023, which is up from previous meetings where they were talking about 5% being the ceiling, if you will. So that's kind of why we've seen this, visceral reaction from the markets. Maybe not today or yesterday, but in the last several sessions, we saw a lot of red and we saw a lot of bleeding, and that's essentially what that was: is the market pricing in higher than expected rates, and that's largely how markets operate, is based on the expectation of future interest rates in the future access to capital or cost of capital. So that's why even a 10 basis point increase to what the market is expecting from interest rates can have really big impacts on the market. So now we're seeing more Fed officials say that we're going to see rates even higher than previously expected, and that's kind of what's driving the market in this very near term cycle. And I think now it's sort of up to the individual to decide if you believe the Fed, right? So in the Fed historically, they're regular people, right? They can't see the future. They don't, because they're operating based off of inflation data and all these different sort of metrics. So it's really about whether or not you believe them, and historically they haven't always been extremely accurate, in their attitudes change from meeting to meeting fairly often. So I think now what we're seeing is we're seeing inflation falling, right? Or I should say CPI inflation falling. But I think going into 2023 what's going to be the case is I would imagine that CPI inflation is going to be sticky at higher values, right? So the Fed always talks about 2% as their goal. It seems unlikely that inflation is going to, or CPI inflation is going to fall from whatever 8% all the way down to 2%, consistently month after month, just decline. I think eventually we're going to reach a point where inflation is sticky around a certain number. Maybe it's 3%, 4%, 5%, whatever. And in that scenario, I think it would likely force the Fed's hand to raise rates even higher than that 5%. Now, the caveat there is the amount of debt that's in the system, right? So when you have a lot of debt in the system, and we look at public debt to GDP levels, which is somewhere around 120%, I want to say off the top of my head, which is obviously extremely high, right? When you have more debt than you have economic output, that's a serious issue, and it historically has been a very disastrous issue to have. But that's a whole different discussion. So with this much debt in the system, is the Fed going to be able to raise rates above 5% and then hold them there for months as they claim they're going to? I would argue probably not. That's probably not going to be able to happen. But once again, that's kind of, do you believe the Fed? And it's also about, do you believe that Powell is this neo Volcker, if you will, right? And that's kind of the attitude he's taken. Here and there in some of his pressers, his post FOMC pressers. So it's whether or not like you believe Powell has the ability or the like the stones to actually just pound demand and keep rates elevated. Um, so and if you guys have any thoughts there, we can always stop.
Yeah, Blake, real quick on that. So, I mean, like, zooming out a bit and kind of digesting and playing back some of your thoughts. Um, Obviously 2022 has been like nuke fest, right? I mean, it's been bring down inflation as fast as possible. That's the objective by raising rates, as aggressively and quickly as possible. And now we have seen like a relative reprieve of that strategy in that, 75 basis points to 50 basis points, and in CPI inflation, coming in a little under expectation. Those are novel things that, in theory, could be the start of a transition of, policy, right? Or at least, 50 goes to 25, 25 goes to flat, right? But it's almost like, because at the same time, you have these objective market factors playing out and then objective policy actions playing out that are less intense than they were, right? Kind of on both fronts. But you've also got this like mega hawkish, uh, language that's continuing to be used. And if you look at what broader markets did, last week, right? It was CPI comes in under the number, uh, markets rally, and then Powell opens his mouth and talks about how he's going to keep the pedal to the metal, and then everything and then some is given back, right? So it's kind of like, I mean, this isn't rocket science, but a deduction of this is the language, the policy, the posturing is more important than the actions. The market based data to some degree, which actually make the crystal ball kind of harder to read, to some degree, because that's based on like relatively subjective human behavior and attitude and action. Right? I mean, is that crazy to think that way, or does that make a little bit of sense?
No, I think that makes complete sense, and that's exactly what I was talking about earlier when I say that the market operates based off of future expectations of interest rates. So yeah, to some extent, and especially in the very near term, the language and the posture of the Fed is what's going to drive markets, because people are taking Powell's word to determine where interest rates are going to be in the future.
I'm totally following there too. Powell's he's stuck between a rock and a hard place, right? He can lower rates again and let inflation just really get completely out of control, or he can keep rates elevated. He can raise them more and just tank the economy. It's an impossible job. I wouldn't want it. So it really, yeah, it comes down to sort of his rhetoric. Like he has to say things to calm the market, because no matter what he does, like something's inevitably going to go wrong, just because the fiat system's so broken and we have so much debt, we're in too deep.
Yeah, and contrarian view to that, or flip side, right? If let's say they raise 75 basis points, but Powell came out and said, hey, things are really looking a lot better. We think we're going to be able to take the pedal off the metal a little bit right now. Right? Market reacts better to that, which is a subjective statement, than it does, decreasing the cut. Right? I mean, it's kind of funny to think about the human element of this, but yeah, I think we beat that one up pretty well. Blake, what are you thinking from an equities perspective? Back to you.
Yeah, totally. So I think from an equities perspective, like I mentioned this week and last week, it was a lot of repricing to really price in the language and the attitude of the Fed Open Market Committee officials, and that's why we've seen this. We saw a big gap up, last week, and then just fade, and a lot of the best stocks that were. And I like to look at the individual stocks, right? Because the saying is, it's not a stock market; it's a market of stocks. So in the way that I analyze the market is looking at what stocks are leading the market at the moment, and clearly, I don't think this would be a shock to anyone. It's not growth stocks. It's not your tech stocks. It's not the stocks that were incredible performers in 2020 and 2021 when the money printer was in full force. And what we kind of saw was in the last few weeks, and the indexes were essentially going sideways, from that period of late November, early December. And obviously now we've started to roll over, but in that time, we had stocks showing really high relative strength. So what I mean by that is in a period where the index is essentially going sideways, but you have stocks that are starting to creep higher, right? That's a sign of strength relative to the general market. And that's where I like to really focus my attention. And so what we saw this week now is as the index kind of rolled over, all those stocks really kind of failed to get above key levels, key resistance levels. And that was like a really big signal to me that, something's kind of going on here in the market. And today we got a nice bounce, right? The NASDAQ was up, 1.5% or so, on light volume though. So to me, it's not, I don't really see institutions, chomping at the bit to start big positions down here. Obviously, you're going to have funds accumulating, a little bit, right, to bring down their average costs. But I'm not necessarily seeing this massive shift in what's going on in the market in terms of buy pressure or we're still sort of seeing this strong sell pressure where at the first sign of weakness, everybody dumps again, and that's just obviously very indicative of a bear market. But speaking about crypto equities and Bitcoin's also in a similar place, I should say. Obviously, we've noticed that Bitcoin generally tends to follow the Nasdaq. Not obviously, it's not one for one, and there's certainly instances where it's a lot different. And right now, the charts look slightly different, but structurally speaking, cyclically speaking, they're going to operate in very similar cycles, right? When stocks are going up every day, Bitcoin's going to go up every day, and when stocks are in a bear market, so is Bitcoin, right? And that's just because they're both risk assets. And whether or not you agree that Bitcoin is a risk asset is a obviously completely different discussion. And I would imagine that a lot of us that are listening to this space would like to believe that Bitcoin won't always be a risk asset, but the fact of the matter is institutional investors view Bitcoin as a risk asset right now, right? So for that reason, you're going to see Bitcoin following the general stock market price action, right? Like the NASDAQ. And crypto equities are just derivatives of Bitcoin, right? They follow Bitcoin with varying degrees of beta. And that kind of gets it gets priced in terms of they have all these different companies. Yeah, they might, public Bitcoin miners might all have, the same objective essentially, right? You want to mine Bitcoin for the least possible operating cost. But not all these companies are the same, right? And I think we'll talk a little bit about, like Core Scientific, for example. That's a perfect example of how could, a Core Scientific be doing, financially clearly not great, but other companies are doing, a lot better, relatively speaking. And that's why the market prices in, these varying degrees of beta to Bitcoin, right? You have varying levels of counterparty risk. You have varying levels of leverage, between firms. So I think really what the name of the game is right now for these public miners is just survival, right? It's literally survival of the fittest. And I think if you're bullish on public miners over the long term, like I am, I'm obviously extremely bullish of these companies over the long term, as an industry group. Now, individual companies, it becomes really hard to say, oh, Riot's gonna be the one that's gonna make it out and perform fantastically over the next 5 years, and oh, but Hut 8's gonna do terrible or whatever. Like it's really hard to say, exactly which companies are going to be the performers. But what I can tell you is the companies that manage to survive this bear market are going to see massive boosts to profits in the coming years, and we're going to see big jumps in those stock prices whenever that cycle is going to change.
Blake, what do you look at real quick there? Just a quick hit. What do you look at when you look at ability to survive and to really quickly quantify, like, kind of the catalyst for the shitstorm? We were talking about this as a team earlier today. It's a perfect storm of bad things that happen. You have surging energy prices, right? You have really negative price action for Bitcoin. Dollarized Bitcoin price is way down, right? So the cost side of the mining equation goes up, the yield side on a dollarized basis goes down, right? And then you also have kind of raging difficulty, which is I definitely think a lagging indicator of sorts, because in order to bring on a significant amount of incremental hash rate, these are longer term investments. And what we're seeing right now in the market, as far as difficulty is concerned, is the byproduct of massive investments in infrastructure and pledges to consume power that were made as far back as 18 plus months ago, where you get when massive bull market and access to very, very good access to cheap capital, right? So it's like when all three of those things happen at the same time, a lot of infrastructure, negative price action, and surging energy costs, it's a perfect storm, right? Like, these companies can manage like two of those variables, right, without being to the point of pain that we're seeing with some of these public miners, and all of them as a broader group. So I guess with that as a backdrop, what do you see? What do you look for in ability to survive and thrive?
Sorry, I forgot to unmute there. That's a really good question. I really like that question, and I think there's a lot of ways you can view it, and it depends on. Well, I would say it's important to kind of look at all of these different lenses for viewing these companies, right? And it also just depends on what sort of investor are you, right? Maybe you don't have a significant background in finance, and you're not super comfortable with reading a 10K or something like that. But from like the sort of more qualitative perspective, I would say, you want to look at, and I'm talking public miners here. I'm not talking about an exchange or anything like that. I think geography is super important, right? And that's kind of been a big key in this cycle. Is energy prices are rising essentially across the board, but it's different in different areas of the country and different areas of the world, right? So understanding how are energy prices rising in Texas versus Kentucky, or stuff like that is important to look at. I would say it's not necessarily the most defining factor. I think also looking at the management team is also super important, right? These are the people steering the ship, and understanding can I trust the chief executive? Is this a seasoned veteran of the space? Is this someone who just kind of dove in head first? And then from there, like, the quantitative stuff is personally what I like to look at, and that's just because I have a little bit of experience analyzing those companies from the quantitative perspective. But like, if you like one thing off the top of my head, like if you wanted to look at a debt to equity ratio, right? Because the issue that these miners are having is, yes, I mean, obviously the number one issue is, right, your margins being compressed. Obviously that's key, but that doesn't, just because your margins are essentially flat, or you're operating right at around break even, that doesn't necessarily mean that your company is going to explode. It depends on the amount of leverage that your company has. And that's really what we've seen is the companies that are way over their head in terms of debt are the ones that are really struggling, because now your cash flows are significantly lower than you were expecting them to be 2 years ago. So like if you look at a debt to equity ratio, which is dividing the total liabilities divided by the amount of equity, or the amount of shareholders' equity in the company, you would see, like, so for example, Core Scientific, which is the big one that filed this week, their debt to equity ratio is something like 3.5 or so. So you have 3.5 times much as debt than you do equity financing, which is potentially an issue. And there's several other companies that have higher debt to equity ratios, and like I said, that doesn't, just because you have a debt to equity ratio above 1 or even above 2, that doesn't necessarily mean that they're going to blow up. But it's certainly interesting to look at. Like, so some of the other ones that have high debt to equity ratios would be like Greenidge, which is GREE. Marathon also has a fairly high debt to equity ratio. TerraWolf has a fairly high debt to equity ratio. And then you can look at some companies that have lower ones, like a Clean Spark, or a lot of the other, a Hive, a Bitfarm, something like that. So I would say, just to answer your question, I like looking at debt to equity ratio in this specific environment, just because leverage and the amount of leverage that these public miners have has become a really big talking point in a really potentially serious issue. And then, like I mentioned, the qualitative stuff is also important, like geography and management.
Right on, man. Cool. Blake, awesome insights, dude. Let's keep it moving. Let's move to Mitch. Mitch, what are you seeing from more of a Bitcoin specific, Bitcoin network, and if you want to take us into anything you're seeing on chain, floor is yours.
Yeah, thanks, Danny. So on chain, I mean, it's looking as bad as it could possibly get, right? We've been, if you look at the key metrics, talking about realized price and the realized HODL ratio, net realized profit loss, and net unrealized profit loss. We've been in this bottom zone about as long as we were in the 2018 bear market. So, and if you're looking purely at on chain and you're not thinking about the macro, it looks like the ship should be due to turn around here. One thing that I pointed this out in our 2023 report, but it's got me pretty excited to think about is the momentum of new entities and new addresses. So at the bottom of a bear market, you're gonna see activity. It's gonna dwindle, right? Because all the retail's gone. Network activity is gonna be basically dead. So when you see the 30-day moving average of new addresses cross above the 360-day moving average, you can see that trend is sort of starting to reverse. So there's more activity, it's picking up, and that's what you would expect when you're looking for the bottom of the bear market to turn around, and that's something we've seen. In the last couple of days, though, we have seen the 30-day moving average drop. So we'll see if it can turn around. It's still above the yearly, so that's something to look for. And then since the fallout of FTX, and I tweeted this a few weeks ago, I suppose, you saw like a huge spike in the balances of smaller entities on chain. So people with 1 to 10 Bitcoin or less than 1 Bitcoin, you just seen this massive spike, and that has not relented at all. Like we're just seeing a huge reallocation from whales to shrimps, and I think in the long run, that's wonderful. So that's something I've been keeping an eye on here.
Love it, man. Mitch, anything else you want to add just in general? Otherwise, we can, pass it to Joe to get into, kind of some of the more mining dynamics. And I'm sure we're going to jam on a number of different topics as we blow through this. But anything else you want to add there, Mitch, before we move on?
No, it's been a pretty low key, last month, 5 weeks or so since the FTX debacle. Realized volatility is low, which we know in Bitcoin that doesn't stay true for long. So we should be due for a move either up or down here shortly. So that's about all that's gone on chain recently. There was a lot
For
of
sure.
leverage in the futures market that was built up, and some of that was cleared out, relatively speaking. But relatively, it's actually still a decently high amount of leverage in the futures market. So definitely some more cleaning out to do. And I think, I don't want to completely say we need to keep an eye out on Binance, but definitely keep an eye out on Binance.
For sure. Cool, man. So, Joe, what are you seeing? I mean, you can obviously you've got creative control, but primarily maybe start with from a mining perspective. Let's jam. What are you thinking?
Yeah, totally. And yeah, great coverage, Mitch, on chain and derivatives. I just want to echo first. I have a few topics mining related that I want to talk about. The first one is touching back on Core Scientific because I think that's super interesting with what's going on specifically in the mining industry. And Blake basically preached this pretty clearly, but I just kind of want to echo the idea. Leverage amplifies returns, right? And like you pointed out earlier, Danny, in 2021, early and the end of 2021, on paper, forecasting what your rig would earn over the next year, mining looked like the perfect opportunity to deploy capital. And obviously, this year has turned out to be the worst, in hindsight, one of the worst times to deploy capital into mining. If you deployed it, at the end of 2021, but back then everyone wanted to do it, and it obviously took time to build out the mining infrastructure. It took time to purchase the rigs from Bitmain. It took time for Bitmain to ship the rigs here, and people took on all that leverage, back in 2021. And unfortunately, instead of amplifying their projected returns of, fantastic, great returns, it ended up amplifying, downside, downside returns. And that's why we're seeing entities like Core Scientific and Argo Blockchain really go through some troubling times. But it is interesting looking through some of the reports that have been filed around Core Scientific. There's a lot of talk about how this bankruptcy really means more of like a restructuring, which is pretty much what happens when you go into bankruptcy. And I know, Danny, we touched on this in a prior call, but it's not like that Core Scientific's assets are all, cash flow negative going to zero. Maybe in aggregate with their high interest payments, they are cash flow negative, but they definitely have some good assets that are, mining Bitcoin at a profit, an operating profit, and the creditors are going to take over those assets and continue running those machines. So it's kind of just a shift of ownership of those assets when entities go under like this, which is kind of an interesting dynamic in the mining industry.
Yeah, Joe, real quick on that, just to level set. I mean, I think it's an important. This may seem super obvious to some, but just to get it out there, like bankruptcy doesn't mean like you are absolutely 100% toast. You're basically just in like a conservatorship where you need you don't make your decisions, and then you need to repay your debtors, and the court looks at where you have good parts of your business, where you have bad parts of your business, what assets you can shed, so on and so forth, right? But it's like the ultimate strategy, the best outcome for shareholders and for debtors in this case is like you kind of wait it out, right? Because to my earlier point, this is a making of a three-legged shitstorm, right? Which is a technical term of sorts, where it's negative price action, raging energy prices, kind of on the back of a macro. All of this stuff is largely macro driven, and then high difficulty driven by significant investments that were made 18 months ago that are coming to fruition right now with a lot of hash rate on the network, right? So it's like, if you believe in mean regression, in any of these ways, I think energy prices probably, in my opinion, the most likely area, especially if you look historically, because of the track record, to have mean regression, right? Which means energy prices are going to come down at some point, right? And it's with demand, with significant demand in energy, that means that there's incentives for power producers to develop more power generation assets, right? Which means that there's more net, power on the grid, which means that at some point, the supply will eventually exceed the demand. I mean, I'm kind of going out there with this as a drastic example, and therefore prices will come down, right? And this is like a total bull case for Bitcoin mining. Bitcoin miners being a part of this solution as you look at energy grid, sustainability over time, right? Because Joe famously said that very accurately that Bitcoin miners are, time and location independent energy buyers of last resort. What better catalyst or incentive can you possibly give, power producers, right? So it's like kind of this. I got a little off topic with this, so back to you, Joe. But in summation, you just need one of these variables to chill out a little bit, and conversely, at the start of this bull market, you kind of had all three of these going in the other direction. And if you look more just kind of 15, 18 months back with the China ban, you get a approximately 30% difficulty adjustment, which is great for miners, reasonable power costs because all those investments hadn't totally hit the grid yet, and easy money, kind of raging macro landscape. And then it just flipped really, really, really quickly. So the velocity of the onset of these variables, plays a big role. For all three of these variables to turn so negative so quickly is almost unprecedented in some ways.
Danny, if I can just jump in, I think one of the points you made there is really key in terms of looking at the energy market, and I think that I'm sure a lot of people know this, but I just really want to hammer home is the energy market is really unique in that when prices are rising, right, you're incentivizing production, so and that's essentially how the energy market operates, right? When oil prices are rising, oil producers would like to make more oil, right? So you're making more money off of it, but it becomes complicated because pulling oil, I'm just using oil as an example, pulling oil out of the ground is a lengthy process, especially to increase the capacity of production that you're already at, and that could take anywhere from 6, 9, 12 months from the point where prices are rising and now energy producers are finally able to react to that change in prices. So and for that reason, I would expect, as you mentioned, energy prices to come down at some point. And I just think, when that's going to be, I don't know. Maybe it's 2023. Maybe it's not even until 2024. But I just kind of wanted to, reiterate. I think that was an important point. And maybe Joe, if you had any sort of insight on, what would you maybe expect energy prices to, do over the course of the next, year or so, and how do you think that's going to, maybe help this sort of contagion that we've seen within the public miners?
Yeah, I totally agree with both of you guys. I mean, I think you guys made some great points. There's a lot of similarities between the energy market and the mining market, right? Both are very capital intensive businesses that can't get built out overnight. And so the market response to high price is delayed, whether it's building out mining infrastructure or drilling for more oil. So totally agree there. As far as timing, when energy prices are going to go down, it's hard to tell. I'm not an energy expert per se, but I do fully agree with Danny that in the long run, this is a market is designed to correct and likely even overcorrect. And I think there's a because of like that dynamic and a few other dynamics, I'm basically hyper bullish on the Bitcoin mining industry over the next 10 years, because I think there's two very interesting big picture dynamics that are going on that's going to flow. And it's kind of going to flow right off the idea of what you guys were just talking about. We have Bitcoin, which the world is actively monetizing from zero. Yes, it's a super volatile process, but I think it's going to likely continue in the long run, especially over the next 10 years. And then two, we have energy production becoming more efficient. So this is, a interesting futuristic example, but we heard about that fusion breakthrough where through nuclear fusion, we were able to create more energy than we put into the process, which was the first time that's ever been done. And I saw, just for example, a company called Helion. They raised $2.2 billion basically to commercialize fusion energy. And in their press release that was on TechCrunch, they basically said they're going to build out a 50 megawatt facility, and they're potentially going to be able to get electricity cost down to 1 cent per kilowatt hour. Now, like, that's not going to happen overnight, right? But I think we're kind of at the point where we're going to see technology enabling cheaper and cheaper energy production. And at the same time, over the long run, the price of Bitcoin is going to continue going further and further up. And when you have cheaper and cheaper energy and higher Bitcoin price, that's just going to massively open the market for more and more Bitcoin miners. And it's basically creating, over, a 10-year period, the perfect storm for mining Bitcoin, as the block subsidy is still going to be fairly relevant. There's still going to be a solid amount of Bitcoin being mined over the next 10 years. And, Bitcoin scaling solutions haven't been fully built out. So it's very also reasonable to expect that if there's another wave of Bitcoin adoption, we're going to see a sustained period of higher transaction fees, which will be even more revenue for miners. And so I think this perfect storm of lower energy prices in the long run, whether it's tech breakthroughs or just more people drilling for oil because the price is currently high, combined with a higher Bitcoin price, I think it's really set up for the perfect storm for Bitcoin mining over the next 10 years.
Totally agree, man. And well articulated in that, context. Like, I mean, I won't opine on that, Joe. I I agree. I think it's a valid point. Um, are you seeing, this is a little bit more of a, kind of right to the point question, but difficulty. Um, I mean, we got a pretty material negative difficulty adjustment, two difficulties back. We came back up, what, about 3%. Currently, I admit I have not checked today, but yesterday, I think it was a double digit, which usually kind of washes out a bit over the 2 week period. But looking at a potentially at another materially negative difficulty adjustment, what do you think as far as, and this is feeding on the back of a lot of the points you've been talking about these long-term investments, difficulty almost being a laggard, indicators of sort of, well in arrears investments. What do you see for difficulty, for like 2023, right? And for even maybe even the next couple of years, and even so, like hash price, right? I mean, the spread is small right now. Survival is the name of the game. Not all are surviving, as is clearly evident, right? What do you think from a difficulty perspective as we can look forward?
Yeah, totally. Yeah, right now I just looked, we're projected to go down about 4%, which will put us below the previous low that we just made in difficulty. So yeah, it's interesting, and it'll be, interesting to see how that plays out over the next 2 weeks before it happens. But yeah, I think there's a few factors that are going to affect difficulty, in the short term and in the long term. One thing that I think is interesting about difficulty potentially in the short term is we saw this Bitmain just released this new firmware for S19J Pros and other Pro series machines. And they basically came out with this firmware that enables those machines to become more efficient, but they have to reduce their hash rate by about 20%. And, there's no guarantee at all that, a majority of miners are going to implement this new firmware like tomorrow. But over time, if they do, that's a material drop in hash rate that we might see, which might lead to even lower difficulty. So not only miners adopting this new firmware would increase their operating profitability of their machine, but enough miners doing this and running this new firmware could actually lower the total network difficulty for everybody and actually make everyone more profitable. So it's in a weird way that potentially every miner could win by implementing this new efficiency gain, at least in the short term.
Yeah, I mean, I think it's like a cool bear. It's a relevant and moderately creative, like bear market, opportunity, if you will, right? Because you go back a year, it's just about getting as much hash rate as possible. Uh, and now it's about basically mitigating costs, right? I mean, like paying 8, 9 cents per kilowatt hour a year ago, relative to the market, there were cheaper options because energy was cheaper, but that was tenable, right? Now it's like you're underwater, right? And an interesting thing, this is again getting kind of into it, but in the context of looking at like just getting as much hash rate as possible versus power draw, right? Between S19J Pros, right, kind of current generation, and then the new generation XPs. I mean, we obviously have a lot of insight into this being our core business. There's an interesting dynamic right now where, if you think, and Joe, I'd love your opinion on this. Effectively, XPs are 40% more efficient, right? They have about the same net power draw, and they produce 40% more terahash per second. So in theory, on like a mark-to-market basis, one-to-one basis, it'd be immensely logical that there would be a 40% premium for the price of XPs. Now, it's also super logical to think that there's an incremental premium over that, justified by the fact that, like XPs are going to be most competitive for the longest. Mining is oftentimes a longer-term game, right? Because you're recouping your capex over time in the event that you're just, mining, stacking as many sats as you can and running the rigs into the ground and so on and so forth, right? And with the halving approaching, competitiveness, long-term competitiveness is becoming more of there's a premium associated with that. So what's that incremental premium? Does it mean that there should be an 80% price premium on a dollar per terahash basis to the pros, or 100% or a 50%? That's a little bit more ambiguous, but they're trading at like, over 100%, probably 130% dollar per T premium. Do you have any thoughts on that, Joe, as to like why XPs have this, kind of overly, more so than what could be considered just face value logical premium on a pricing perspective?
Yeah, no, I mean, I think you made some great points as to why it is the case, but I would also argue that XPs basically have this, kind of opportunity to where, hey, if Bitcoin does fall further, difficulty is likely going to fall as every other machine is going to turn off before yours because XPs are the most efficient machine. If you're operating at the similar power rate, and so you kind of have this built-in hedge with XPs that you're always going to have, or not always, but you're likely always going to have in the short term, even if the price of Bitcoin just tanks, a positive cash flow, which is very appetizing to a lot of investors. And still, if you're long-term bullish Bitcoin, the value of your XP could go up. Your cash flows over the next 2 years could explode if Bitcoin goes to something like 100K. So you still kind of get a lot of upside, but you also get that downside protection. So I think that's a big source of why there's a premium for XPs, in my opinion.
Yeah.
But I also think, real quick, the firmware coming out for the J Pro is pretty interesting. It makes the J Pro have that, at least some, not to the same extent, of course, but some sort of like downside protection, and makes them a little bit more competitive. So maybe prices for J Pros will go up if this firmware is legit, and maybe XP prices could come down slightly, but we'll see.
Yeah, for sure, man. I think like one other point I'll add on that, and then we'll wrap it up here pretty shortly, is like let's assume that demand for mining is a total demand is a constant, right? And you've got this interesting factor where XPs, it's kind of, let's think Bitcoin. Let's put our Bitcoin hats on. Like XPs are relatively scarce. They've only been in delivery for approximately 4 months. So there's less XPs in circulation than J Pros, right? And in this, so you've got this scarce asset of sorts to begin with. And then as you look at basically pros being right around break even, I think like 8 cents, 8.2 cents, something like that is probably the break even on J pros right now. That demand is then, which is a constant over the whole, market, is shifting to XPs, which places that incremental premium. So if, in theory, right, if we get some price recovery, we get a material negative difficulty adjustment, and S19J pros become, get back in the money for the, so to speak, right, and for a little bit more of a perceived elongated time period, it's logical to think that, if this disproportionate premium still exists, that some of that demand will then shift back to the S19J pros, right? And then, in which case, that could be a catalyst for XP, price reduction, which would probably coincide with S19J Pro price appreciation, which is something that we talk about all the time, is central to the point that Bitcoin miners are not just yield machines. They're more like dividend paying assets, and that asset has a value. So right now, if I'm thinking about like buying miners, I'm looking at S19J Pros as a probably, slightly higher risk yield play. This is not financial advice, right? But just kind of spitballing here. But potentially, most likely, a, a, a more lucrative opportunity for asset side appreciation, right? It's not incredibly difficult for S19J pros to go from 2,000 to 4,000 in price, but it's more challenging for XPs to go from 6,000 to 12,000. And if you're allocating a certain amount of fixed capital towards either of those, your likelihood of getting a more material asset side appreciation on an upside play out is more likely on pros, but the risk there is that you're going to be carrying an asset that might have a very small and potentially negative yield, right? So I'm kind of down in the weeds here, but that's the way I've been thinking about this lately. So I figured I'd share those insights.
Yeah, totally agree. And like, I think a historical example of kind of what you're talking about to this, an extreme historical example is kind of looking at back at like the S9, how it behaved during the bear market of 2020 and then up until, mid 2021. These rigs were basically like scrap metal. People, you could buy it for $40, and the rig itself, just holding it, actually outperformed Bitcoin fairly significantly, from the bottom of the 2020 bear market up to the top of the 2021 bull market. So yeah, that's an extreme example, but yes, if you buy the less efficient machine, you definitely have potentially more upside appreciation if the price of Bitcoin runs on the machine itself. And obviously, your cash flows are gonna, soar as well. But you carry that short term risk of, hey, this machine might not be spitting off positive cash flows if the price of Bitcoin goes down further.
Yep, spot on, man. Love it. All right, guys. We usually run these for once upon a time 30 minutes and 45 minutes, a couple times 90 minutes, but I think we've beat up, sufficiently a lot of important topics, things that we're seeing right now. Any final thoughts before we wrap it up?
Yeah, just one thing I feel like I really picked up on this conversation was if you're going to mine, you have to take ownership of the variables you can control. Because the two biggest things, price and network hash rate, you have no control over that. So if you can minimize debt and you can buy the right machines, you can mine in a place where there's going to be, low energy that's not, the prices aren't too volatile. You don't have to worry about, the government shutting your operation down. That's really what you need to be doing. So just take control of the things you can, because you have no influence over price or other people getting online.
It's a good point. And it's something we talk about a lot, which would be a whole nother, onion to peel back, is just to kind of talk about the onion for a second without peeling it all the way back, is, mining is an extraordinary opportunity to arbitrage, the world's greatest asset, right? You can basically make Bitcoin at a price that is lower than the spot value of Bitcoin. If everybody could do that, it would be an absolute no-brainer. right? If there were no risks, incremental risks associated with it, everybody would do it, wouldn't they? Right? But what you're doing in mining is you're basically, that's your opportunity, which you get in exchange for what you can effectively categorize as execution risk. Right? I mean, you're talking about physical machines ingesting a lot of power in a data center or at your home, but that's not scalable most likely, nor is it economically feasible because of retail power rates. So that's where, and this is something we kind of pride ourselves on, is like if you think about execution risk, you want to be eliminating counterparty risk to the largest degree possible. You probably can't completely eliminate counterparty risk unless you want to, fully do this on your own, and it's a big capital investment, a big operational responsibility, and I have to have the aptitude to do it, and so on and so forth. But you want to minimize like incremental counterparty risk. You don't want to shop the execution obligation to somebody who shops it to somebody else, who shops it to somebody else, and then you've got compounding counterparty risk. So I think that is one thing I think just in general with which I love seeing just Bitcoiners rally around this is like, not your coins, not your keys, not your coins kind of thing. That kind of mantra is just, this all stems from counterparty risk. All this shit that's happened this year has nothing to do with Bitcoin. Right? So it's like one thing that I think a lot of people have really learned is that in this year is that counterparty risk is real. Do your due diligence, and it sets you up for mitigating that risk and therefore having a greater likelihood of success.
Yeah, dude, Danny, that was awesome, and there's no possible way I could have said it better. But I just want to, thank everyone for listening, and if you tuned in late, like I would imagine most of you guys did, it'll be on YouTube for you guys to watch back later. And I think, I would highly recommend going back to the beginning. I think, this was probably the best conversation that we've had on one of these spaces.
Right on. Everybody have a great night. Blake is going to the Blackhawks game, so good luck, Blake. Let's go Hawks.
Go Hawks. Yeah, happy holidays, guys.
There we go. All right, cheers, everybody. Take care.